Goldman Sachs is delivering exactly what investors want right now: strong growth, high returns, and disciplined costs. But the stock is already pricing in that strength. So the real question is simple. Is this still an opportunity? Or are you paying for peak conditions? Goldman just reported a very strong quarter. Revenue grew 14% year over year, and return on equity came in at 19.8%, which is high for a bank in this regulatory environment. Growth is being driven by investment banking and financing activity, which means deal-making and capital markets are active again. At the same time, costs are under control and the business mix is improving. The company is shifting toward higher margin financing and away from lower margin trading intermediation. That's why earnings are expected to grow faster than revenue, with forecasts calling for over 26% EPS growth this year. This matters because the story is no longer just markets are strong. It's the business is structurally becoming more profitable. The stock is trading around $908, while fair value is estimated at $730. That's about a 22% premium. In other words, the market is already pricing in strong execution and favorable conditions. Now look at what's implied. Goldman is expected to deliver mid-teens returns on equity over time and around 9% long-term EPS growth. That's solid, but not extraordinary. This matters because you're not buying a turnaround. You're buying a high-quality bank at a price that assumes things go right. There's very little margin for error. The key shift is the restructuring of the business. Goldman has moved away from consumer banking after losing billions and is now focused on two core engines: global banking and markets, and asset and wealth management. This changes the story because revenue is becoming more stable. Wealth and asset management already make up about 30% of revenue and are growing faster than the rest of the business. These are fee-based, recurring revenues, which reduce cyclicality. At the same time, Goldman is expanding its financing business from $4.2 billion in 2020 to $12.3 billion in 2025, which improves margins and deepens client relationships. The biggest risk is cyclicality. Investment banking and trading are still tied to market conditions, and current levels may be near peak. Management itself expects a slowdown in the second half of the year. If deal activity or trading volumes normalize, earnings can drop quickly. There's also regulatory risk and capital requirements, plus the reality that this is a highly macro-sensitive business. This matters because even a strong franchise can see earnings swing significantly. The upside comes from a combination of sustained deal activity and continued growth in wealth and asset management. There's also a large amount of private equity capital, dry powder, that could drive a multi-year M&A cycle. If that plays out, Goldman benefits on multiple fronts: advisory fees, financing, and asset management flows. This matters because the business is now positioned to monetize the entire life cycle of capital markets activity. Goldman Sachs is a high-quality, well-positioned bank that is executing well and improving structurally. The business is better than it was a few years ago. The problem is the price. At current levels, you're paying for strong conditions to continue and for the strategy to work without disruption. That doesn't make it a bad company. It just means this is no longer an obvious investment. I'll break down the next one soon. Subscribe if you want to stay ahead.